Okay, good morning, friends. Good morning, friends. Okay, let's continue with the capital budgeting discussion. Maybe for some 30-45 minutes, we'll discuss on capital budgeting, the balance areas, and then I move to the next areas. Let's come to question 21. WX Limited is considering a proposal to replace an existing machine. The details of existing machine and new machine are as under. Particulars: existing machine, new machine, cost of machine, present estimated life, present book value. Out of the life of 10 years of present machine, 5 years have already lapsed. Management can continue with this machine for the remaining lifetime. Activity level is same, residual value is 60,000, there will be a saving of 2,40,000 in variable cost. If the old machine is sold, then it will fetch 90,000. Minimum return of 11%, corporate tax. No depreciation is to be charged in the year of sale. You are required to comment on the suitability of replacement of the old machine. Go through this. Okay, this is also a question on replacement of machine. The bigger difference is in the last year when you are selling the asset, you should not charge depreciation. That's questions specific requirement that you should not charge depreciation in the last year when you are selling the asset. Maybe that could get reflected as short term loss or short term gain. I am not sure. When you do the calculation, you will understand. We purchased this asset for 3,75,000. 10 years of life. 5 years have already passed by. Now the book value is 187,500. So the book value as of now is 187,500, which means every year they would have charged depreciation of 37,500. Give me a minute. Just give me a minute. Friends, you are able to see the screen? Okay, the asset was purchased for 3,75,000. After 5 years of depreciation, the asset value is 187,500, which can you close the door? Which indirectly mean the depreciation per annum is 37,500. They have been charging depreciation of 37,500. I have purchased a new asset which will have 5,25,000. There will be a residual value of 60,000. This will have a life of 5 years. The only thing is, in the last year when you are selling the asset, you should not charge depreciation. Technically that doesn't make any big difference. You will understand how it doesn't make a difference when we do the calculation. Let's start. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Particulars: existing asset, new asset. Existing asset, new asset. We'll calculate the incremental cash flow. Existing and new asset. For existing, you'll have to calculate NSV of existing asset. And for this you will have to calculate capital expenditure. Initial outflow, NSV of existing asset, capital expenditure and initial outflow. Now the new asset, the capital expenditure on that new asset is 5,25,000. 5,25,000. For the existing asset, computation of NSV of existing asset, sale value, book value. Today what is the sale value of the old asset? What is the sale value of the old asset today? 90,000. Book value is 187,500. Loss on sale. Loss on sale. Tax saved. There's a loss on sale, so we are going to save tax. Tax saved is 30%. Tax saved. And NSV is sale value plus tax saved. Sale value plus tax saved. And net my initial outflow is the incremental number, new minus old. The incremental number is new minus old 4,05,750. New minus old 4,05,750. That is the initial outflow. The initial outflow is 405,750, which is the extra outflow which is happening. Working note 2, in between flow, particulars, old machine, new machine. Now it has a balanced life of 5 years. The only thing is I'll split it as year 1 to 4 and year 5. Reason for this variation is question has clearly mentioned that you are not going to charge depreciation in the year of sale. Saving in cost, new machine will save you 2,40,000. New machine will save you 2,40,000. Old machine, nothing is mentioned in the question. Saving in cost of new machine is 2,40,000. There will be a saving of 2,40,000 in variable cost by the usage of new machine. The saving in cost is technically PBDT. There are no expenses given in the question, so this is technically PBDT less depreciation 37,500 0. 37,500 and 0. In the last year I cannot charge depreciation. In the year of sale depreciation cannot be charged. This is 5,25,000 minus 60,000 divided by 5 years. SLM method, 5 years life. So last year we don't charge depreciation, but the life is anyway 5 years. 5,25,000 minus 60,000 divided by 5 years. No depreciation here. So PBT less tax, PAT, add back depreciation, CFAT. So this could be a loss making scenario because I don't have other information here. The tax rate is 30%. We get PAT, add back depreciation and CFAT. And what matters is new minus old, which is 184,650 and 1,68,000. New minus old. This will go to my final step when I calculate the NPV. Year 1 to 4 the cash flow will be 184,650 and the last year the cash flow will be 1,68,000. New minus old. Then comes your working note 3, which is on terminal flow. The problem is this question has said no depreciation in the last year. I'll tell you that is an irrelevant adjustment per se. Even if you ignore that also you'll get the same answer. But from an exam point of view, obviously presentation has to be that way. The old asset, new asset. Old asset will be sold for 0. New asset will be sold for 60,000. New asset will be sold for 60,000. It has a residual value of 60,000. Old asset today can be sold for 90,000. After 5 years nothing is mentioned, so it is 0. It will have a book value of 37,500. What is this 37,500? Is the last year depreciation. Last year you did not charge depreciation. This will have a book value of 5,25,000 minus 93,000 into 4, which is 1,53,000. What is that 1,53,000? Is technically 60,000 of residual value and last year depreciation. You did not charge the depreciation in the last year. So this will become loss on sale. On loss on sale you are going to save tax and your NSV number is, and the incremental NSV number is 76,650. Now if you see last year the cash flow is 244,650. The last year the cash flow is 244,650, which is nothing but I could have charged depreciation here. If I had charged depreciation here 37,500, 93,000, I would have got same 184. This would have been 0. this would have been 60,000. So charging depreciation, not charging depreciation does not really matter in the last year, because last year automatically it will get reflected as STCL or STCG. So the point is, the question specifically wanted us to do it this way. Else I could have calculated 184,650 for all 5 years and added the salvage value of 60,000. I would have got 244,650. Just added the salvage value. But question specific requirement is no depreciation is to be charged in the year of sale. I should not charge any depreciation in that year. Let's come to question 22. Company UVW has to make a choice between two identical machine in terms of capacity A and B, designed differently, exactly do the same job. Machine A will cost 7,50,000, 3 years, 2 lakh per year to run. Machine B is an economy model costing only 5 lakh, will last for only 2 years, 3 lakh per year to run. The cash flows of A and B are real cash flow. Opportunity cost of capital is 9%. Which machine should the company buy? Go through the question. Okay, this problem has information only on outflow, so we calculate PV of outflow. Another issue here is machine A has a life of 3 years, machine B has a life of 2 years. So we will calculate PV of outflow. After PV of outflow, in order to make the decision, I'll have to calculate equated annual cost, because the life is different. Obviously a 3-year machine will have higher outflow as compared to a 2-year machine. So working note 1. Computation of PV of outflow. Computation of PV of outflow. Year cash flow PVF DCF. Year 0, the outflow is 7,50,000. I am writing outflow as positive item. If there is any inflow, we will write it as positive, so negative item. 1 to 3. 2 lakh, 7,50,000 and 2 lakh. The annuity factor is 9%, 1, 2.531. So the PV of outflow is 12,56,200, 12,56,200. Equated annual cost is equal to PV of outflow divided by annuity factor for the number of years of life. The life in this case is 3 years. So this will be called as equated annual cost. 4,96,326 divided by 2.531, equated annual cost. The annuity factor is 2.531 for 9% for 3 years. So I have divided by that. When it comes to machine B, it has an initial outflow of 5 lakh. It takes 3 lakh to run. Can you tell me the 2-year annuity factor? 9% annuity factor for 2 years. How much? 1.75? 9. So this has an outflow of 10,27,700, which is lesser than 12 lakh. But from an equated annual cost point of view, machine 1 is better. The first machine is better from an equated annual cost. Equated annual cost is PV of outflow divided by annuity factor. PV of outflow divided by the annuity factor. Clear? Any doubts on this? Let's come to question 23. BT Pathology Lab Limited is using an X-ray machine which reached at the end of their useful life. Following new machines are of different brands with same features are available for the purchase. Brand XYZ ABC, cost of machine, life of machine, maintenance cost, rate of depreciation. Residual value shall be dropped by 1/3 in the first year and thereafter will be depreciated at the rate mentioned above. Alternatively, ABC can be taken on rent and be returned back to the owner after the use on the following terms and condition. Rent shall be paid at the beginning of the year. First year will be 1,02,000. Rent for subsequent years will be 1,02,500. Last 5 years will be 109,950. Rent agreement can be terminated by making a payment of 1 lakh as penalty. The penalty would be reduced by 10,000 each year of the period of rental agreement. Advise which brand can be acquired if you want for a period of 20 years and if you want for a period of 5 years. Go through this. Okay, I need an X-ray machine. My purpose could be for a period of 20 years. Another purpose is for a period of 5 years. If you look at XYZ has a life of 15 years. ABC has a life of 10 years. And you can also take ABC on rent, which also has a life of 10 years. Requirement is I need it for 20 years. So I don't have data to calculate for 20 years because I have data of only 15 years, 10 years and 10 years. So what we will do is, there are only outflows again in this question. You will calculate the PV of outflow for 15 years, PV of outflow for 10 years, which is your buying of ABC, PV of outflow for 10 years, which is the renting option. And for all the three, you will calculate equated annual cost. For all the three, you will calculate equated annual cost. Whichever alternative has lower EAC, you go ahead and select that from a point of view of 20-year life. If it's a 5-year life, buy XYZ and sell it at the end of 5th year. Buy XYZ and sell it at the end of 5th year, put only 5-year cash flow. Buy ABC and sell it at the end of 5th year, only 5-year cash flow. Rent ABC and terminate the agreement at the end of 5th year, only 5-year cash flow. Whichever gives, there is PV of outflow, no EAC to be used. Whichever has lower PV of outflow, that is the option to be selected. Now let's try to put the cash flows alone. First one is purchase of XYZ. Purchase of XYZ. I'll focus on year and cash flow. I'm not going to do discounting at all. Discounting is something you can do. Year cash flow. Year 0, I have an outflow of 6 lakh. Year 0, I have an outflow of 6 lakh. Year 1 to 5, I will have an outflow of 20,000 maintenance. 1 to 5 outflow of 20,000. 6 to 10, outflow of 28,000. 11 to 15, outflow of 39,000. Now in calculator, if you want annuity factor for 6 to 10, what you should do is 1 divided by whatever the number you put equal to, that's the first year factor, don't do anything, equal to second year, equal to third year, equal to fourth year, equal to fifth year. After that, when you put equal to, put m plus 6th, 7th, so it will add 6, 7, 8, 9, 10, or you manually note it down and then add them together, whatever way you are. Now at the end of 15th year, I am going to sell this. Now what question says is 6 lakh is the cost. It will go down by 1/3 in the first year itself. It will go down by 1/3 in the first year itself. The cost of the asset will fall by 1/3 in the first year. So 6 lakh minus 2 lakh, it will become 4 lakh. And after that, it will be depreciated at the rate of 4%. Depreciated at the rate of 4%. So 4% of 6 lakh, okay? 4% of 6 lakh, the original cost of the asset. So minus 24,000 into 14. Can you do this and tell me? 4 lakh minus 24,000 into 14 years. 4 lakh minus 24,000 into 14 years. 64,000. This is my salvage value, minus 64. This is an inflow. This is an inflow. So minus 64,000. Whatever is the PV of outflow, divide by the 15-year annuity factor and get the EAC. Divide by the 15-year annuity factor and get the EAC. Minus 64,000. This is an inflow from the asset. My value is 6 lakh. Minus 1/3, which is 4 lakh, minus 24,000 per year for another 14 years. 24,000 because they said at the rate of 4% for all the subsequent years. Thereafter shall be depreciated at the rate mentioned above. The next scenario is year cash flow. Year 0 the outflow is 4,50,000. Year 1 to 5 31,000. 6 to 10 53,000. And at the end of year 10, from 4,50,000 1/3 value is gone, 1,50,000 is gone, you are left with the value of 3 lakh. Depreciation is 6% of 4,50,000, 6% of 4,50,000 which is 27,000. So 3 lakh minus 27,000 into 9 more years, 27,000 into 9 more years, 57,000. So this is second option. You calculate the PV of outflow, divide by the annuity factor of 10 years and get the equated annual cost. Third scenario is going for renting. Year cash flow. The thing is the rent is to be paid at the beginning of the first year. Beginning of the year is nothing but year 0. Beginning of year 1 is nothing but year 0. So year 0 my rent is 1,02,000. This is the first year rent, okay. This is to use the asset for the first year, you are paying it in year 0. Then they are saying annual rent for the subsequent 4 years, again that will be paid at the beginning of the year. So 1 to 4, 102,500. This is technically the rent for second to 5th year. Second to 5th year, because you have paid rent for the first year and day 0, then you are paying rent. And then it says for the next 5 years is 1,09,950. This is technically the rent for 6th to 10th year. Again, this is not a 9-year life, this is a 10-year life. You will have to divide by the annuity factor of 10 years and see whichever has the better equated annual cost. I am not repeating the 5-year calculation. In 5-year calculation, your salvage value will have to be calculated at the end of 5th year using the same logic, 1/3 fall minus whatever is the depreciation into 4 years balance life. And when it comes to rental option, I think there is some penalty also to be paid. You will have to pay a penalty of 1 lakh is the penalty. If you terminate the agreement in between, the penalty will keep reducing by 10,000 each year for period of rental agreement. That is, if you terminate the rent agreement after 1 year of usage, you will have to pay a penalty of 90,000. After 2-year usage, you will have to pay a penalty of 80,000. 3-year usage, you will have to pay a penalty of 70, 4-year 60, 5-year 50. So that part I am not doing it. So we get the PV of outflow. After the PV of outflow, you divide by the annuity factor and then decide which is the better option. Here option 1 turns out to be better. Option 1 has the lowest equated annual cost. When it comes to the second requirement, I just calculate PV of outflow. I don't go by any calculation on EAC because all the 3 has a life of 5 years. Even if you divide by 5 years, you will get the same EAC, similar EAC. So automatically the decision is made on the basis of PV of outflow. Okay. Apart from this, I think one more concept which is there. One is your capital rationing. I am doing question 25 for that. And there's another concept called as modified IRR. I don't think so it's there in the material, so you can just see that. Let's come to question 25. A company has 1 lakh available for investment and has identified the following 4 investments in which it has to invest. 40,000, 1 lakh, 50,000, 60,000. NPV is 20, 35, 24 and 18. You are required to optimize the returns from the package of projects within the capital spending limit. If projects are independent and are divisible, projects are not divisible. There are 2 scenarios, both are there in this question. Go through this. I am coming to it. Okay, capital rationing basically refers to a situation where I have limited amount of money. I have how much? 1 lakh. All 4 have positive NPV. So given a choice, I would want to do all the 4 projects. 40,000 plus 1 lakh, 1 lakh 40 plus 50, 1 lakh 90 plus 60, 2 lakh 50. I don't have sufficient money to do all the projects. So I'll have to do a pick and choose job. So 2 lakh 50. Availability is 1 lakh, so capital rationing exists. Now, how do you do a pick and choose job is, you do a ranking. So, let's do ranking of projects. ranking of projects, project investment, NPV, profitability index and rank. Ranking happens based on profitability index. Ranking happens based on profitability index. Investment and NPV is given in the question: 40,000, 1 lakh, 50,000, 60,000. NPV is 20, 35, 24 and 18. Now, what is profitability index? Is inflow by outflow. Inflow is nothing but outflow plus NPV is the inflow. Outflow plus NPV will become the inflow, because the formula for NPV is inflow minus outflow. So, my inflow is nothing but NPV plus the outflow. Outflow is the investment. So, this plus investment divided by investment. NPV plus investment divided by investment. You can express it in percentage, you can express it in times. So, I have done the profitability index. This is my rank 1, this is my rank 2, this is my rank 3 and this is my rank 4. This is my preference. First preference is project C, second preference is project E, third preference is project D and last preference goes to project F based on the profitability index. Projects are divisible, that is easier scenario to do. If divisible, I have 1 lakh available. So, what I am going to do with 1 lakh is project C. First, I will do project C. I will do project C. Project C will take away 40,000 of my money. Then I will do project E. Project E will take away another 50,000 of my money. I am left with 10,000. With 10,000, I am going to do project D. I am going to do project D. Divisible means you can do 1 by 10 of project D. 1/10 of project D. Project D needs 1 lakh rupee. You need not invest 1 lakh, you can invest 1/10 of that. If you invest 1/10 of that, you will get only 1/10 of the NPV also. You will get only 1/10 of the NPV. You are not doing the full investment, you are doing a partial investment. That is called as divisible project. Now, this combination will give me an NPV of 20,000, 24,000 and 3,500. 20,000, 24,000 and 3,500. This is called as divisible project. This is an easier part. If projects are not divisible, you will have to go through combination approach, trial and error. I'll start with rank 1. With that, I'll try to see if I can combine some other project, rank 1 and rank 2, rank 1 and rank 3, rank 1 and rank 4, whatever is possible. So, project C and E, only C and D, I am not adding anything beyond that, because C and D itself will take away 90,000. I have a limit of 1 lakh. Then I do C and D is not possible. C and D is not possible because D itself needs 1 lakh. So, C and F will take away 1 lakh. Then project D on a standalone basis. E, I don't think so I can add it with anything. Project E, which is my rank 2 project, I am not able to club it with any other thing. E and C we have already clubbed. E and F is not possible. E and D is not possible. I don't see any other combination possible. Check if you can do any other combination with 1 lakh being the limit. Your limit is 1 lakh. In that 1 lakh, if you can put any other combination, we will add it. Else, I see this combination. I think ICA material may have F as a standalone answer also. But that doesn't matter because F is anyway part of this. So, they may have an answer called as F as a standalone. For all this combination, we calculate the NPV. Okay, only 3 combinations they have given. Calculate the NPV, whichever gives you maximum NPV, you do it. Indivisible means more restriction, so you earn only lesser amount. Here you are earning 47,500. Here you are earning 47,500. Here you will earn only 44,000 because there you were having extra 10,000 and you did a part of the project. Here you did not have that flexibility. So, this is on your divisible projects and indivisible and capital rationing. Let us just go to those few additional questions which were added. Go through question 12. go through question 12, page 195, the additional questions. We want to do a quick discussion, go through this, go through question 12. Okay, it's a manufacturer of computers. It wants to introduce AI while making computers. It estimates that annual savings from artificial intelligence includes a reduction of 5 employees with annual salary of 3 lakh. So this is one of the in-between inflow. Savings of 5 lakh into 5 people into 3 lakh, 15 lakh savings will be there. This is another inflow, 3 lakh saving, another inflow, 2 lakh 50 reduction in loss sale, another saving of 2 lakh from billing issue. So all put together, this would be the benefits of the new system. Just give me a minute. So the benefit of the new system is all this. 21 lakh is the cost of the asset, the salvage value is 0, so depreciation will be 4 lakh 20. Operation will require 2 computer specialists with annual salary of 5 lakh per person. So 10 lakh is an expenditure, 1 lakh 50 is an operating expenditure. So if you try to calculate cash flow, 5 into 3 lakh, 15 lakh of saving plus another 3 lakh of saving, 18 lakh plus another 2 lakh 50 of saving plus another 2 lakh of saving. In that, these are the expenses, you have depreciation and do it. Now I want to discuss more on this. You are required to obtain the cash flows and the NPV on the assumption that book salvage value for the depreciation purposes 2 lakh, even though the machine is having no real worth in terms of its resale value. Also the book salvage value of 2 lakh is allowed for taxation purpose. Originally you see here your depreciation is 4 lakh 20. Your depreciation is 4 lakh 20. You calculate the cash flow. Initial outflow is 21 lakh. Every year inflow is 8 lakh 96. NPV calculation was not asked in the question. Now they are saying, though the salvage value is 0, but I will still consider the salvage value to be 2 lakh for the purpose of income tax. I will consider the salvage value to be 2 lakh for the purpose of income tax. So in the second part, my depreciation will be 21 lakh minus 2 lakh by 5 years, and this 2 lakh will go to the last year, and this will be a capital loss on which you will save taxes. This will be a capital loss on which you will save taxes. So indirectly, if you see here you get 8 lakh 96. In this case, you get 8 lakh 84, which is a reduction of 12,000. Which is a reduction of 12,000. That reduction has happened because of depreciation. That reduction has happened because of depreciation. But every year 12,000 reduction. So 5 years, you get that as salvage value 60,000. You get that back as salvage value of 60,000. But obviously the second part will have lower NPV. It will have lower NPV as compared to the first part. The reason for lower NPV is simple, because this you get it at the end of 5th year, there you are getting every year. So every year that will have a better present value, this will have a lower present value. Let's come to 13. Superb Limited construct customized parts for satellites to be launched by USA and Canada. The parts are constructed in 8 locations around the world. The finance director chooses to implement video conferencing to speed up the budget process and save travel cost. She finds that in earlier years, the company sent 2 officers from each location to the central headquarters to discuss the budget twice a year. The average travel cost per person including airfare, hotels and meals is 27,000 per trip. The cost of video conferencing is 8,25,000 to set up plus 300 per hour average cost of telephone time to transmit signal. A total of 48 hours of transmission time will be needed to complete the budget. The company depreciates this over a period of 5 years. Alternative is to rent the facility, which can be rented at 1,500 plus 400 per hour for telephone charges. You are required to know whether it is worthwhile to implement video conferencing. Now, what is happening is this company was earlier doing the budget preparation. For budget preparation, the employees were required to travel and come to the central place. So they were earlier not having video conferencing. Against this I have 2 choices now. One is no video conferencing, own video conferencing, renting video conferencing. You will have to decide which is better, because I can either go for owning. If you want to go for owning, you will have to spend this much, and then there is some extra expenses to be spent. If you go for alternative approach, which is renting of the local conferencing facility, there you have to spend some 1,500 per hour and 400 per hour average cost for telephone charges. You will have to decide which one is a better option. Now, earlier what used to happen is, I think it has some 8 location including the central headquarter, 8 location including the central headquarter. So basically from 7 locations people have to come and reach this place. From 7 locations people have to travel and come. So if you were doing the earlier system, I think the average cost, travel cost per person including airfare, hotel and meal is 27,000 per trip, and 2 officers have to come twice a year. So if you don't go for video conferencing, 27,000 into 7 location, 27,000 into 7 location, 2 people from each location 2 times a year, 2 people from each location 2 times a year, you will have to spend 7,56,000. You will have to spend 7,56,000 on travel cost. We will have to spend 7,56,000 on travel cost if I am not implementing the video conferencing facility. If I implement the video conferencing facility, I will have to incur 8,25,000 plus 8,25,000 to set up a system at each location. So every location it's 8,25,000 plus 300 per hour average cost of telephone time to transmit signal. A total of 48 hours of transmission time will be needed to complete the budget each year. So now the problem is, if I go for purchase 8,25,000 system, but it has a life of 5 years. It has a life of 5 years. So into 8 location, every location you have to do this. Every location you have to, so indirectly you will have to spend this 13,20,000. On top of that, 300 per hour to transmit signal, which is 48 hours of transmission time would be needed. One thing which is not very clear is this 300 per hour average cost is per location or all 8 location put together. It doesn't seem to be very clear. The 300, is it per location or all 8 locations put together? As of now I am taking that this is for all locations put together. Because I will be using this asset for over a period of 5 years, no? So next year I am not going to spend on the video conferencing capital cost, no? This is a capitalized cost, no? Video conferencing, this whatever you are paying 8,25,000 not for 1 year, no? That is paid for a period of 5 years. So next year you will not have this cost, but there is a depreciation on that technically. and on top of this 48 into 300. This is possible to be multiplied with 8 also, okay. This is possible that it gets multiplied with 8. I am not sure what is there in the answer. 48 into 300 is what I am writing as of now. We'll see. We'll see.
Before the 300, it is mentioned to set up a system at each location plus 300 per. So we can like.
No, so I read this each location for 8,25,000 plus 300 per hour average cost of telephone time to transmit signal. A total of 48 hours of transmission time will be needed to complete. Okay, I prefer this would be better answer. Let me do into 8. I'm not sure. Let's check. Into 8 should be better. Should be each location. Can be each location. So let's do into 8. Then an alternative approach is to rent local facility, which will be rented at 1500 per hour plus 400 per hour of telephone charges. 1500 per hour plus 400 per hour. So 1500 into 48 hours into 8 location. Into 48 hours into 8 location, and 400 again I have done into 8. So I think it is better to go for renting of video conferencing facility. Renting of video conferencing facility. See, in this analysis, we are not considering an element of non-qualitative or non-financial factor, which we do at CA final level. For example, the experience of a video conferencing vis-a-vis a normal physical is totally different. So your budgets can be better when it is at a face-to-face discussion, because in a video conferencing you will not be sure whether the participation is always there from all people. So those are non-financial factor which we are not bothered about. 756, 1435 200 and 729 600. So we will go with 729 600. 14 we had already discussed. Go through 15. Go through 15. Okay, let's look at this question. It's considering replacing a manually operated old machine with a fully automatic machine, fully depreciated for tax purpose. This is a very important statement. Fully depreciated for tax purpose, which means there is no depreciation left on the old asset. But as a book value of 2,40,000, the machine has begun causing problems with breakdown and it cannot fetch more than 30,000 if sold in the market at present. Sale value is 30,000, book value will be 0 if you are doing the calculation. It will have no realizable value after 10 years. The company has been offered 1 lakh for the old machine. So for the old machine, the person is offering 1 lakh in return of 4,50,000. You will have to buy a new machine for 4,50,000. The life of the new machine, the salvage value of the new machine is 35,000 after 10 years. The company follows straight line depreciation method, but for tax purpose, WDV method at 7.5% is allowed, taking this is the only machine in the block of assets. So they are saying follow block of assets method. Follow block of assets method, and the rate of depreciation is 7.5% under WDV method. Given below are the data. On top of that, last line says ignore capital gain tax. Ignore capital. So one, I'll have to follow block of assets method for calculating depreciation. Second, even if this is the only asset in the block, there cannot be any capital gain or capital loss, because there is question says ignore capital gain tax. My initial outflow will be 4,50,000 of outflow and 1 lakh of inflow on the sale of the old asset. So net outflow will be 3,50,000. Net outflow will be 3,50,000. Can you do subtraction at this stage and tell me PBDT of both machine? Tell me PBDT of both machine, not PBT. Or add back the depreciation. You add back the depreciation which is there. Tell me the PBDT of both machine. 3,48,750. Okay, which means the extra PBDT is 80,000. Extra PBDT is 80,000. Because I have to follow WDV method, I have calculated the extra PBDT which is 80,000. PBDT of the new machine is technically 80,000. You will have to subtract depreciation every year, and depreciation is under WDV method, and the opening WDV in the block of assets will be 3,50,000. Why will it be only 3,50,000? You buy for 4,50,000, your block has zero value. You buying for 4,50,000, you are selling the old asset for 1 lakh. So you will be left with only 3,50,000 under Income Tax Act. You will be left with only 3,50,000, and beyond that there is nothing much to discuss. You keep charging on 3,50,000. You keep charging on 3,50,000. At the end of 10 years, salvage value is 35,000. No concept of NSV calculation, because we are not having any taxation on your capital gain. Even if this is the only asset, it may have this value 1,60,000 in the block, but for this 1,60,000 you are not going to get any tax benefit. No STCG, no STCL, because the question says ignore capital gain tax. Okay, go through 16. I'll quickly discuss this. AC on AC on antarla. Go through question 16. Okay, now let's look at ABC & Co is considering whether to replace an existing machine or to spend money on revamping it. ABC & Co currently pays no taxes, which indirectly mean I will have to ignore taxes. Replacement machine will cost 18 lakh, require maintenance of 2 lakh at the end of every year for 8 years. At the end of 8 years, it will have a salvage value of 4 lakh and would be sold. The existing machine require increasing amount of maintenance. That's the data. Opportunity cost is when should the company replace the machine. The question is not asking whether the replacement is to be done or not. Question's requirement is when should you replace the machine. First scenario, I replace today. Which means on day 0 I will get an inflow of 8 lakh. I will have an outflow of 18 lakh, and 1 to 8 years I will have an outflow of 2 lakh. At the end of 8 years, you will have an inflow of 4 lakh. So this is a scenario of 8-year life. Second situation is you will replace it at the end of year 1. When you replace it at the end of year 1, year 0 nothing happens. Year 0 nothing happens. Year 1 you will incur 2 lakh. You will get an inflow of 5 lakh. You will have an outflow of 18 lakh. Year 2 to 9 you will have to incur maintenance costs, and at the end of year 9 you will sell the new asset. So it will have 9-year life. Then replace at the end of year 2, which will have a 10-year life. Replace at the end of year 3, which will have a 11-year life. Replace it at the end of year 4, which will have a 12-year life. For all these 5 options, we'll have to calculate equated annual cost, because the first option has a life of 8 years. Replacing today means overall life is 8 years. Replacing at the end of year 1 means 9-year life, year 2 means 10-year life, year 3 means 11-year life, year 4 means 12-year life, and then you do the calculation. Okay, quickly go through 17. I just want to discuss an item called a sensitivity analysis. Go through 17. How is? If you replace today, old machine 0 years, new machine 8 years, put together 8 year. If you replace at the end of year 1, old machine 1 year, new machine 8 years, put together 9 years. Old machine 2 years, new machine 8 years, it will go on like that. Go through 17. I want to discuss on something called a sensitivity analysis. Okay, let's look at this question. Stan Limited is contemplating replacement of one of its machine which has been outdated and inefficient. He has decided machine 1 and machine 2. This is not a replacement decision problem. This is like a new purchase itself because they have given no data on the old machine. New machine, initial investment 12 lakh, 16 lakh. Life 3 years and 5 years. The life is different. So when you do the calculation, you may get an NPV answer or an EAC PV of outflow, but life is different, so you'll have to go by either EAC or EAB, equated annual cost or equated annual benefit. Residual value, contribution per annum, the new machine will earn so much. Fixed maintenance cost, other fixed cost. In that other fixed cost, one more information is maintenance cost are payable in advance. So first year maintenance cost will be written in year 0. Second year maintenance cost will be written in year 2. So it will go first year. Third year maintenance cost will be written in second year. All other cash flow occur at the end of each year. Depreciation is under straight line method and has been included. The expected cost of capital, the important word again is here. Ignore tax. If I am ignoring tax, I am not bothered about calculating depreciation, calculating tax. So machine 1, initial outflow is 12 lakh. Then contribution is year 1 11 lakh 60. I am going to write it like this: year 0, year 1, year 2 and year 3. So 1160, 1160, 1160. Maintenance cost will be 40,000 here. Year 0, year 1 and year 2. Maintenance cost will be in year 0, year 1 and year 2. And then we have another item called as your other fixed cost, which is 7 lakh 20. In that depreciation is included. You have to eliminate the depreciation. You will have to eliminate the depreciation. So your cash flows will be like this. And for this you calculate the EAB 291, 191 and 372, 291. This is the equated annual benefit. This is the equated annual benefit. The maintenance cost is written as year 0, 1 and 2. The maintenance cost is written as year 0, 1 and 2. I am not bothered about the taxation and other things because anyway the question has told us to ignore it. Another important element is calculate the sensitivity of your recommendation to changes in the contribution generated by machine 1 to the changes in contribution generated by machine 1. Machine 1 is currently generating a contribution of 11 lakh 60. Every year it is generating a contribution of 11 lakh 60. What has happened is, as of now my choice is to go with machine 2. My choice is to go with machine 2. What is sensitivity is basically going to lead to a reversal of decision. What is reversal of decision? We are selecting machine 2. Can I go to machine 1? From machine 2, can I go to machine 1? I can go to machine 1 if this EAB is also 3 lakh 72 291. If this EAB is also 3,72,291. This EAB can be 3,72,291 if my contribution goes up. If my contribution, what is the difference in EAB? Can you tell me the difference in EAB? How much? 81,100. And if the contribution can go up by 81,100, if the contribution can go up by 81,100, I will change my decision. I'll change my decision. That is basically called as the sensitivity analysis. I can change my decision if the contribution changes by 81,100. With this, we have kind of done with your investment decision discussion. I think a bigger topic. This is completed. I'll move to an area called as management of working capital. We'll move to an area called as management of working capital. Go through this for maybe 3-4, I think I'll give you 5-6 minutes. Go through this and then we start doing it. Is the AC remote there? Okay, you go through this first. Go through the theory part. The material is not there as of now, so they'll have to print it. So I'll tell them, let me. Yeah, that is there. Hard copy material. Okay, let's start with the working capital chapter. Now, this chapter is classified into multiple sub-segments. The first segment is working capital estimation. Under working capital estimation, we are going to learn about operating cycle method, WC estimation for existing company and new company. WC estimation for existing company and new company, and another segment called as MPBF, maximum permissible bank finance calculation. This is one segment of the chapter. The second segment of the chapter is on cash management, where we have cash budget, optimum cash balance as per Baumol model. This is basically same as your EOQ. You would have learned as your EOQs, the same concept you will use here. The third part is on receivables management, where you need to decide whether to extend or shorten or tighten credit, extend or tighten credit given to a customer. Along with that, factoring analysis. Along with that, there will be a factoring analysis. These are the multiple segments which are there as far as this chapter is concerned. Apart from this, there can be one or two questions even on inventory management or payables management. This chapter is basically, the first part is on working capital estimation, second is on cash management, third is on inventory management, which is what you learn in costing. So there haven't been any question as such on inventory management. Then payables management, receivables management, and last segment is MPBF, maximum permissible bank finance. So let's start with operating cycle method. Under operating cycle method, what we are trying to do is, we are trying to find how much time does it take for a company to convert the cash back into cash. So your cash becomes raw material, then becomes WIP, then becomes FG, then becomes debtors, then become cash. So your operating cycle is equal to raw material days plus WIP days plus FG days plus debtor days minus creditor days. Raw material days is calculated as average stock of raw material by raw material consumed. WIP days, average stock of WIP by cost of production. By cost of production. FG days is equal to average stock of FG by cost of goods sold. Debtor days is equal to average debtors by credit sales, and creditor days is equal to average creditors by credit purchases. See, the denominator is basically an item which comes next in the cost sheet. For example, your cost sheet format is opening stock of raw material, add purchase, less closing stock. After that, you get raw material consumed. So the denominator is raw material consumed. Then after that, you have direct labor, direct expense, you get prime cost, factory overheads, you get gross works cost, add opening WIP, less closing WIP. After closing WIP, you get net works cost or COP. So COP is the denominator. Add opening FG, less closing FG, you get cost of goods sold. So COGS is the denominator. Profit and sales. Sorry, after cost of goods sold, you may have other overheads, cost of sales, profit and sales. So receivables is obviously dependent on credit sales, payables is obviously dependent on credit purchases. Then I also have something called as individual estimation of working capital. Individual estimation is, I'm going to estimate each of the items separately. I'm going to do an estimation of each of the items separately. When you want to do individual estimation, we'll have two types of problem. One for an existing entity, another one for a new entity. For an existing entity, the format is simpler because the assumption for an existing entity is opening FG is equal to closing FG, opening WIP is equal to closing WIP, opening raw material is equal to closing raw material. So first you will have to prepare a cost sheet. So you start with direct material, direct wages, overheads other than depreciation, GWC, NWC, COP, COGS, because your opening WIP and closing WIP is same. So your gross works cost and net works cost will be same. Opening FG and closing FG is same. So your COP will be COGS. Once you are done with this, this is how you estimate. Raw material is on raw material consumed, WIP is on cost of production, what I said there. Your FG is on cost of, this can be on even cost of goods sold technically. FG can be on cost of goods sold as well, or cost of production depending on the data in the question. Debtors is on credit sales, creditors is on credit purchases. Then you have to do it for a new entity. When you do it for a new entity, same format, but you will have to write opening and closing. Opening stock of raw material, closing stock of raw material. Opening will be 0. Opening will be 0, closing will have a value. Opening WIP 0, closing WIP will have a value. Opening FG 0, closing FG will have a value, and then you prepare the cost sheet, and after that you do the estimation. Working capital forecast, based on that you do a statement. There are two types of approach. One is called total approach and second is called cash cost approach. In total approach, we include everything like non-cash item and also consider profit. In cash cost approach, depreciation will not be written. Depreciation will not come, not applicable. Profit will also not be captured. Profit will also not be captured. Then you have your cash management, where you calculate your optimum cash, square root of 2 into annual demand of money. Like you have annual demand of raw material, like you have ordering cost, here it is called transaction cost, and like you have carrying cost, here it's called opportunity cost. This is on your maximum permissible bank finance. There are three methods of calculating MPBF. Method 1 says 75% of current assets minus 75% of current liability. Method 2 says 75% of current assets minus 100% of current liability. And method 3 says there is something called as core current asset, non-core current asset, 75% of non-core current asset minus 100% of current liability. Let's directly get into some problems. Let's go to question 1. Go through question 1. Go through this quickly. Okay, we are required to calculate operating cycle period, number of operating. This is a fairly simple question because all the data is almost there. Let's start. Operating cycle is equal to raw material plus WIP plus FG plus debtors minus creditors. Raw material plus WIP plus FG plus debtors minus creditor. Raw material given in the question is 45, WIP is 20, FG is 25, debtors is 30, creditors is 60. How many days is this? 60 days. So one cycle to convert the cash back into cash, it takes 60 days of time. Number of cycles in a year is 360 divided by 60, 6 cycles in a year, 6 operating cycles in a year. Amount of working capital required on cost basis. Now in this, I'm not sure whether I have okay, on cost basis, whether I wanted to mention on cash basis, I don't know. There are two ways of calculating your working capital. One is on cash cost approach and second is on total approach. I'll do both here. Total approach means 25 lakhs into 60 by 360 and cash cost means 22 lakh 50, depreciation is ignored, okay, into 60 by 360. Not sure whether there was a typing error. 60 by 360. Company is a market leader in its product and has no competitor. Based on a market survey, it is planning to discontinue sales on credit and deliver products based on prepayments in order to reduce its working capital. You are required to compute the reduction in working capital requirement in such a scenario. Reduction is now the cycle is 60 days. Debtors will not be there. So cycle will fall down to 30 days. Cycle will fall down to 30 days. So my working capital now will be 25 lakh into 30 by 360 or 22.5 into 30 by 360 and you can tell how much is the reduction in working capital. Whatever is the amount it turns out to be, whatever is the reduction in working capital. Both approaches I am presenting because I am not sure what is needed. Amount of increase if all purchases are made on cash basis. All purchases are made on cash basis. So your creditor will not be there. So from 60 days it will now go up to 120 days. From 60 days it will go up to 120. So what is the increase we'll have to see. It is assumed the company is following cash cost approach for estimating working capital. So the answer had only cash cost approach, but the problem was not clear. So we ended up presenting both. But here the question has been solved using only cash cost approach. Go through question 2. Go through 2. Okay, Again similar requirement, I want to calculate what is the net operating cycle period, how many cycles are there in a year, amount of working capital requirement. The difference between the earlier question and this question is they have not given those days directly. So let's start. Raw material days is equal to average stock of raw material by raw material consumed. Average stock of raw material by raw material consumed. Your average stock of raw material, tell me the average of 45,000 and 65,536. Sorry, 65,356. Average stock of raw material 55,178. Raw material consumed is opening stock plus purchases minus closing stock. Opening stock plus purchases minus closing stock. How much? 3 lakh 644 into 365. We'll keep it as 2 decimals for the time being. Finally, I'll round off the number of days. How many days is this? 53.05 days. We'll do the final rounding of later. 53.05 days. WIP days is equal to average stock of WIP by cost of production. Average stock of WIP by cost of production. Average is 35,000 and 51,300 average. How much? 43,150. Cost of production is 7,50,000 into 365. 20.99 days. Okay, next FG days. Average stock of FG by cost of goods sold. Average stock of FG by cost of goods sold. Average of FG 6181, 7175 average. How much? 65,178 divided by COGS is 9,15,000 into 365. 20? Okay, 25.99 days. Then you have debtor days, which is on your average debtors. Average debtors. Tell me the average debtor number. 1,23,561 divided by credit sales 11 lakhs into 365. 40. Okay. Then creditor days. Creditor days is your average creditors 50,079 plus 7469 by 2. How much is that? 60. Okay. 274 divided by 4 lakhs into 365. 55 point? Okay, 55 days. Now I'll get my operating cycle is raw material plus WIP plus FG plus debtor minus creditor. So operating cycle is, calculate and tell me. Raw material plus WIP plus FG plus debtor minus creditor. 86 days. I'll round off at this stage. Operating cycle is 86 days. Then they've asked number of operating cycle. Number of operating cycle is 365 by 86. We will have this in decimals itself. 4.24 operating cycles. And last requirement is working capital. Working capital is calculated based on annual operating cost. It's calculated based on annual operating. They have not mentioned about depreciation and all. So no concept, no confusion of total approach and cash cost approach here. 9,50,000 into 86 by 365. Whatever number you get, 9,50,000 into 86 by 365. Any doubts on this? Okay, this is the second type of a question. Let's come to the third type of a question. Go through this. Go through question 3. Go through question 3. Go through this. Okay. Again, we are required to calculate the working capital requirement by operating cycle method. We are required to do the same thing: raw material days, WIP days, FG days, debtor days, creditor days. The only difference is the previous question gave you all those numbers like COP, COGS. Here you will have to first prepare a cost sheet. We'll prepare a cost sheet, only cost sheet I'll prepare. Balance part is a formality which I'm not going to do, which you know how to calculate raw material days, how to calculate WIP, how to calculate FG, debtor, creditor. So let's focus on preparing a cost sheet. Cost sheet of Beta Limited. Cost sheet of Beta Limited for the year ended March 2011. I am not bothered about calculating prime cost, all those things I'm not going to get into it. Even if you write prime cost doesn't matter, because prime cost is not going to help me in solving my problem. So it may not be exactly the format which we follow. Particulars amount, direct material, opening raw material, purchases less closing raw material. What will go to the outer column is your raw material consumed. Opening raw material given in the question is 1,80,000, purchases is 11 lakhs, closing raw material is 2 lakhs. So raw material consumed is 10,80,000. Then we have direct wages. Direct wages is 3 lakh. Direct expenses are, let me use the word whatever they have used, production expenses 2 lakhs. At this stage we will get GWC, gross works cost. I have not written prime cost. At this stage I'll get gross works cost. Add opening WIP less closing WIP, we get net works cost / cost of production. The difference between net works cost and cost of production is those 5 line items which you could see in cost sheet, but here anyway I am ignoring all of that. None of them would be there in the question mostly. Opening WIP is 60,000, closing WIP is 1 lakh. You get cost of production. Add opening FG less closing FG, we get cost of goods sold. Opening FG given in the question is 260, closing is 3 lakh. Cost of goods sold. We have some admin expense and selling expense. Assumption is this admin is general admin expense. If you treat it as relating to production, then it will go above, but if it's relating to production, it should have been in the trading account rather than in the P&L account. They have put this in the P&L account. General admin expense, selling expense, cost of sales, profit and sales. Your general admin expense is 175, selling expense is 75,000. Cost of sales is technically annual operating cost, okay? That's technically annual operating cost, 2,50,000. Sales is 20 lakh. Your raw material days will be calculated based on 10,80,000. WIP days will be calculated based on 15,40,000. FG days will be calculated based on 15 lakh. Debtor days would be calculated based on 20 lakh. And creditor days would be calculated based on 11 lakh. Creditor days would be based on 11 lakh. Obviously, you will have to do average stock of raw material, average stock of WIP, average stock of FG, average debtors, average creditors. But the base is this. That is what is prepared in the cost sheet. Okay. Now we are going to move to an area called as individual estimation, line by line estimation. You are going to prepare an individual estimation of a cost sheet. We have done what under operating cycle method. Now we'll move to individual estimation. Go through question 4. Go through question 4. go through the question. Okay, now I have to do estimation of working capital. Question has not told you to follow operating cycle method, which means you'll have to do individual line by line estimation. If the question does not say operating cycle, you'll have to follow individual estimation. Your wish, you want to follow total approach or cash cost approach, that's your choice. Okay, both approaches will give different answer. I think in the solution I follow total approach, so I'll follow total approach for this calculation, but your wish, you can follow even a cash cost approach. In the question, nowhere they are mentioning that it's a new company, nowhere they are mentioning it's a new project, so it's an existing company. First thing we'll prepare is a cost sheet. Working note 1, cost sheet, particulars, calculation, amount. The cost sheet will make it very simple, starting with direct material. No concept of opening stock of raw material, closing stock of raw material, because both are same as the assumption. Direct material, we are required to prepare the cost for 78,000 units. 78,000. So 78,000 into 117. 78,000 into 117. Then we have direct labor, which is again 78,000 into 49. Then we have factory overheads. If I was following total approach and cash cost approach, I'll split. Cash cost approach will not include this depreciation of 18. It will not include the depreciation. 78,000 into 98 as it is. 98 as it is. The total is called GWC, NWC, COP, COGS and even COS in this question. There are no other cost. The question has not mentioned about any other expense. So this is also the cost of sales. This estimation is critical because when you do the this cost sheet will be very useful when you do the estimation part of it. After this you have profit, sales. Profit is I think 36 per unit. And selling price is some 300. So this is my simple cost sheet which has been prepared. Some question you may feel that you can even do without a cost sheet, but many questions you will struggle if you don't do a cost sheet. So it's okay to spend maybe 2-3 minutes on the cost sheet. Once the cost sheet is done, working note 2, estimation. Current assets, will write the format. Then maybe some 7-8 lines, and current liabilities, current assets and current liability. Now you read the question, somewhere you will get to know one of the items, any item could be there. First line says average raw material in stock. So stock of raw material. Stock of raw material is based on raw material consumed. It's based on raw material consumed, which is there in the cost sheet. 91,26,000 into, it says 4 weeks, so 4 by 52. If they have used 4 weeks, I do 4 by 52. If they say 1 month, I'll do 1 by 12. I'll do 1 by 12. 1 by 12. So 91,26,000 into 4 by 52. Into 4 by 52. Next is stock of WIP. This is very tricky. Stock of WIP is on cost of production, but they will give something called as degree of completion. The cost of production which we have calculated is 2,05,92,000. This has to be split into 2. This has to be split into 2. Material cost is 91,26. Other cost is 1,14,66,000. Other cost is 1,14,66,000. If the problem is silent, take this number, do into 2 by 52 and do into 100%. The normal assumption is degree of completion for WIP is 100. Take this number, do again into 2 by 52 and do into 50%. The normal assumption is the degree of completion is 100% and 50%. 100% for this, 50%. The question has said take this as 80 and this is 60. 80% and 60%. Whatever is your cost of production, split into raw material cost and other cost. Raw material cost into 2 by 52 into 100% is the normal scenario. This question into 80%. Other side, normally you take 50%. This question you are taking 60%. So this calculation is 91,26,000 into 2 by 52 into 80% into 80%. That's the question specific requirement. Balance number 1,14,66,000 into 2 by 52 into 60%. So put together it turns out to be 545,400, 80% and 60%. Then we have stock of FG 2,05,92,000 into 3 by 52, 3 weeks. It said 3 weeks, so 3 by 52. Debtors, it is on sales, but it's on credit sales. Somewhere the question has said company sells 1/5 of the output against cash, 1/5 of the output against cash. So 4/5 is only credit sales. So 2,34 lakhs into 4 by 5 into 4 by 5, which is your credit sales, into what's the credit period given? How much is the credit period given to debtors? 6 by 52. 6 by 52. That is your debtors portion. Credit from the supplier, creditors, credit allowed from supplier 8 weeks, 91,26,000 into 8 by 52. 91,26,000 is your raw material purchased or raw material consumed. Both are same because your opening stock and closing stock is anyway going to be same. Then we have wages payable. The wages expenditure is 38,22,000. So 38,22 into 1 by 52. Overheads payable, which is 2 weeks, 76,44 into 2 by 52. 2 by 52. Apart from that, there is a cash balance of 2,50,000. Cash balance of 2,50,000. On top of this, questions can give you some margin maintenance and all. They can say some contingency margin is to be maintained. My working capital is the gap between this, which is some 30,73,900. Any doubts on this? Important part is WIP estimation. Important part is WIP estimation. Is there any other item? Overheads, what happened? 70. Okay, sorry. In overheads, by mistake, I've also included depreciation. So depreciation, you cannot have any outstanding overheads for that. So that part alone have to be removed. 6240. In fact, one thing which we should do is, it's better to do it this way itself. Factory overhead other than depreciation and depreciation. Other than depreciation and depreciation. This is into 80. This is into 18. This into 18 will not come. It will not come if you are following the approach of cash cost. It is better to write it this way because your outstanding overheads will anyway be on only 62,40,000. Depreciation, you cannot have an outstanding depreciation kind of a thing. Go through question 5. Go through 5 and start doing a cost sheet. Do a cost sheet. Prepare a cost sheet.
So I did with cash costing, question number 4. But I'm not getting, like, profit itself is different.
It will be different. Profit is 0 for cash cost. In fact, we don't even write the profit there. And the answer is obviously going to be different. Prepare the cost sheet. I just want you to quickly prepare the cost sheet. Spend time on cost sheet. Cost sheet is what is most critical rather than the estimation. Estimation is just a formality. Spend time on cost sheet. Spend time on cost sheet. Please get the cost sheet correctly. Your wish, which approach you want to follow. I think the problem is silent again. Okay, cash cost. Last line says cash cost basis. You have to do it on cash cost basis. Get the cost sheet. $54,000 into 120 is direct material. Your selling price is 200 rupees and that 60% is raw material cost. 54,000 into 120, 54,000 into 20, 54,000 into 40. I'm not writing anything in profit, and the total, this is technically not sales, this is technically called as cash cost of sales. But in a format we write it as sales only, but this is technically cash cost of sales. It is technically the cost of sales rather than the sales. I'm not going to write any profit in the cash cost approach. Any doubts on the cost sheet? I'll get into the estimation part then. Estimation though takes more time, but that's more of a formality. There's nothing much you're going to learn out of estimation. Estimation, except for one or two adjustments here and there, everything is going to be more like a formality. It depends on your cost sheet. It depends on your cost sheet. So STN Limited is a ready-made garment company. Production cycle indicates that material are introduced in the beginning. Wages and overheads accrue evenly. Following figures: selling price, duration of production cycle 1 month. This is for WIP. Stock of WIP is 1 month. One thing is, they have mentioned 50% of wages and overheads are supposed to be conversion cost. Technically they are mentioning degree of completion for wages and overheads is 50%. For material, the degree of completion is 100%. It's introduced at the beginning of the production cycle. So my stock of WIP is raw material into 1 by 12 into 100%. 1 by 12 into 100%, and then this direct labor factory overhead into 50% into 1 by 12. 50% into 1 by 12. Direct material directly into 1 by 12, and for direct labor and overheads I've added them, made them 50% and did into 1 by 12. Your production cycle is 1 month. Duration of production cycle is 1 month. Any doubts on this? Next we see raw material inventory held 2 months consumption. So stock of raw material is, it's a formality. Take this into 2 by 12. Into 2 by 12. You will keep changing the period alone. Sometimes it could be 4 weeks, sometimes it could be 8 weeks, 2 months. Then stock of FG is 1 month. You will have to take this number into 1 by 12. Into 1 by 12. Then we have credit allowed to debtors 1.5 month. Okay, there is no concept of cash sales in this question. Listen, credit allowed to debtors, take this cash cost of sales. Take cash cost of sales, not the normal sales. not the normal sales. That's why I did not write profit. I did not write profit into 1.5 by 12. Then we have credit allowed by creditors 1 month. So creditors is this number into 1 by 12 into 1 by 12. Then we have wages are paid in the next month following the month of accrual, which means outstanding wages is 1 month. Outstanding wages is 1 month. So wages payable into 1 by 12. Outstanding wages is this. Then we have cash is held to the extent of 40% of current liability. Current liability is 6,30,000. Cash is 6,30,000 into 40%. Into 40%. On top of this, you add a margin of 15%. They said safety margin of 50%, and final working capital. Final working capital. Safety margin is 15%. And my final working capital is this. What matters is the cost sheet. You get the cost sheet correctly, your problem is over almost. Almost problem is over if you get the right cost sheet. If I had followed total approach, the only difference would have been debtor. Debtor would have been on the sales. The question said us to follow cash cost. WIP is the most important part. The most important part is WIP estimation. Go through this, prepare the cost sheet, and then okay, first you prepare the cost sheet. I'll tell you if anything else is to be done. Prepare cost sheet first. Cost sheet, estimate WIP, estimate debtors. Follow cash cost approach. Okay, follow cash cost approach. Cash cost approach, prepare cost sheet. After that, estimate WIP, estimate debtors. Yeah, follow cash cost approach. That is what I have done in the solution. I want you to prepare a cost sheet, estimate work in progress, estimate debtors. Please write the cost sheet. I want you to do that. Please prepare cost sheet, estimate WIP, estimate debtors. I don't want to do anything beyond that. Prepare cost sheet, estimate WIP and debtors, nothing beyond that. We are following cash cost approach. Estimate work in progress and debtors. Your cost sheet should look something like this. Material is 1,44,000 into 45. Labor is 1,44,000 into 20. and overheads is 1,44,000 into 40. Profit is 0. I'm following cash cost approach. Profit is taken as 0. I wanted to estimate only 2 items, WIP and FG. Only 2 items are to be estimated, WIP and FG. For work in progress, the degree of completion will be taken as 50% for both. 50% for both material as well as labor and overheads. 4 weeks means you'll have to do into 4 by 52. You will have to do into 4 by 52. And when you do debtors calculation, you will have to take the cash cost of sales, not the normal sales, do into 80%. Into 80% because 20% of the output is sold against cash. And then on top of that you will do into 2 by 12. Some of them are in weeks, some of them are in months. For months you will have to do 2 by 12, for weeks you will have to do 4 by 52. The WIP figure I get is 5,81,538. 581,538. That is, I have taken the raw material costs into 4 by 52 into 50%, wages and overheads into 50% into 4 by 52. And when it comes to debtors, cash cost of sales into 80% into 2 by 12. Yep.
Material rate 64 lakh 80 into 50% because I got different WIP. I'm telling you the split, sir.
Okay.
I did 64 lakh 80 into 50% into 4 by 52. Labor and overheads 8640 into 50% into 1.5 by 52.
Where is 1.5 coming from? WIP is 4 weeks, no? Okay, let's come to 7. No, Krishna, RM is not always 100%. The question has to say, because we saw a question where RM was 80%. In this question, RM is 50%. It's no rule that it has to be always 100%. Go through question 7.
Actually, I thought of asking the same question, sir. Material always 100%.
The question has to mention, no? Question, if silent, I'll take 100%. 150 is normal rule. If question says something else, I can't do much about it. Last question said, take wages and overheads 50%. Material we took 100%. Previous question said material 80%, wages and overhead 60%. This question everything is 50%. If the problem is silent is where assumption comes, no? Go through 7. I'll focus on preparing the cost sheet. My focus will be on the cost sheet. Estimation is not the big part of it. Go through 7. Okay, we are going to prepare a cost sheet. Question wants us to prepare it under both total approach and cash cost approach. So let's prepare the cost sheet. The cost sheet also looks different under total approach and cash cost. Let's do this. Particulars, total approach, cash cost approach. Slightly different from the earlier questions. Total and cash cost. Again, it's an existing company. Existing company becomes simpler. Also, there are talks of depreciation being there, counting depreciation as part of COP. So, depreciation is there in this question. Maybe it's not given. So, how do we get to that? We'll see. Starting with direct material. Direct material. Raw material consumed given in the question is 9 lakhs. Direct material is 9 lakhs. Then we have direct labor, which is 7,20,000. Factory overheads, depreciation. I cannot ignore depreciation in this question. There is a depreciation also. Factory overheads, they said manufacturing expenses outstanding at end of year is 80,000. Outstanding at end of year is 80,000. Cash expenses are paid 1 month in arrears. So basically this 80,000 is 1 month expense. This 80,000 is 1 month expense. So my manufacturing expenses 9,60,000. 9,60,000. Apart from this, depreciation is there. We'll see depreciation later. Cash cost is 0 this side. This total is GWC NWC, COP, COGS. No, COS will not come because there are other items like your admin expense and sales promotion, they are there. This side I'll put a total. Question has mentioned the gross margin is 25%. The gross margin is 25%, counting depreciation as part of COP. In short, COP is 75%. Your gross margin is 25%. So COP is 75% of 36 lakh. 36 lakhs into 75%. Depreciation is a balancing figure which will be 1,20,000. Depreciation is a balancing figure. Other side I am not going to write depreciation. Cash cost approach I am not going to write depreciation. We can write it like this: factory overheads other than depreciation and for example, if you are going to calculate FG, stock of FG, the formula is COP or COGS into whatever the time period. For total approach you will take 27 lakh, for cash cost approach you will take 25 lakh 80. For when you do WIP, for total approach you will take 27 lakh, for cash cost approach you will take 25 lakh 80. Then we have admin expense, sales promotion, cost of sales, profit and sales. Admin expense they have mentioned 2,40,000 paid as above. Paid as above just mean that they are paid 1 month in arrears. It is not that it is 1 month expense. They have just said total admin expense. Paid as above means they are paid 1 month in arrear. So this will, there will be an outstanding administration expense when we calculate. So this is 2,40,000. Sales promotion is 1,20,000. Cost of sales is 30/60 and 29/40. This is 36 lakhs. Profit is 5,40,000. This side 0. This side 29/40. When you estimate debtors, your debtors will be calculated on 29,40,000 under cash cost approach. Debtors here would be calculated on 36 lakh. 36 lakh into 2/12, 2 months credit. But other side you will have to do 29/40 into 2/12. Estimation I am not getting into much of it. This is a simple formality. When you do total approach, take the number from total approach value. Here you take it from cash cost column, 29,40,000 into 2/12. There you take on 36 lakh into 2/12. So you take the appropriate value from whichever approach you are following. Okay, come to question 8. Come to this. I'll quickly discuss few items here. Okay, it's like a normal problem on estimation only. The only issue is I'm not going to prepare a cost sheet in this question. The reason for not preparing a cost sheet is the data has some inaccuracy. Now in an exam scenario you may not be able to find the data has inaccuracy or not. So if the same question gets repeated, you can directly do the estimation without preparing a cost sheet, because there is some issue with the data, because when I prepare a cost sheet the numbers were not adding up to what is given in the question. Question talked about some GP margin of 20%, it was not adding up to that number. So there was some inaccuracy in the problem. Now sales will be, debtors will be 24 lakh into 1/12, 24 lakh into 1/12, 1 month's credit. Export sales 10,80,000 into 3/12, 10,80,000 into 3/12. Material used 9 lakh into 2/12, suppliers extent 2 months credit. So 9 lakh into 2/12, this will be your creditor figure. Wages 7,20,000 into 0.5/12. Manufacturing expenses 10,80,000 into 1/12. Administration expense 2,40,000 into 1 by 12. Sales promotion 1,50,000 into 1 by 4 quarterly in advance. Income tax payable 2,25,000 into 1 by 4. One installment is not paid. Rate of GP is 20%. Ignore work in progress and depreciation. The problem is this GP was not fitting in. That's why I'm not preparing a cost sheet. If I prepare a cost sheet, the GP amount was not fitting in. So I can calculate stock of raw material also. Stock of raw material is raw material consumed into 1 by 12. Finished stock is where we will struggle. Finished stock is where we will struggle, because for finished stock I need COP or COGS. I need one of them, COP or COGS. Now listen. COGS is equal to 80% of 24 lakh. 80% of 24 lakh, which is the domestic sale, plus the GP margin is 20%. The problem is your domestic sales happen at 100 rupees, profit is 20, this is 80. Just because you are exporting, the cost of exports cannot be lesser, because what you are doing is you are selling it at a lower price. Exports are being sold at a lower price. Because we are selling it at a lower price, my cost cannot come down. Indirectly, the GP margin can't be 20% for export sale. In export, you are selling it at 90. Cost will continue to be 80 and this is 10. Cost will continue to be 80 and your profit is only 10. Profit is only 10. In short, the cost here is 10 lakh 80 into 80 by 90. This was 80 by 100. This is 80 by 90 into 80 by 90. Let's not get into calculation part of it. I want to discuss few more things in this question. Read this line and tell me what will come in current asset and what will go in current liability. Read this carefully and let me know. What should go to current asset, what should go to current liability? Or only current asset or only current liability? Read it carefully. What do you mean by this and what should go? What amount should go to current asset, what amount should go to current liability? Let me know that. Or only current asset, only current liability. What is the current asset? No, ignore stock and all. Believes in keeping 2,50,000 is a cash. That is a cash. Believes in keeping 2,50,000. So tell me what should go to current asset, what should go to current liability? How much is the cash balance? How much is the overdraft balance? Whatever is the sense. How much? It is not yet utilized, so it cannot go to current liability. Not yet utilized. So what should I keep us? Read it carefully and let me know. I want some answer so that I discuss it. If you face this in exam, what are you going to write as cash balance and what are you going to write as overdraft balance? 1 lakh? Okay, it's only cash and it's only 1,75,000. See, I want 2,50,000 margin with me. When I say 2,50,000 cash, I want immediately there is a need, I need 2,50,000. So what I am doing is at my home I am keeping 1,75,000 cash. And I know a friend who will give me 75,000 whenever I ask. So that is a limit which I have with my friend. That limit is not yet utilized by me. So it cannot be a liability for me as of now. So cash is 1,75,000, bank overdraft is 0. If you had utilized this, cash would have become 2,50,000, bank overdraft would have become 75,000. See, net I need 2,50,000. If I have the limit with me, I will need lesser cash. If limit is not there, I will need more cash. So cash will be 1,75,000. A cost sheet has been prepared here, but this is not going to fit into that number. I had to take another expense balancing figure and all. It was not fitting into that number which was given in the question. Sorry. Cash is 1,75,000. Cash is 1,75,000. Clear? Any doubts on this? Go through 9 and I want you to prepare a cost sheet, estimate WIP. Cost sheet, estimate WIP. I'll let you know if I want you to estimate anything else. Prepare a cost sheet, WIP and debtors, two things. Cash cost approach again. It's your wish, you can follow any of the approach. It's not necessary that cash cost is to be done. Cost sheet, WIP and debtors. Okay, your cost sheet would look something like this: 6,000 into 80, 6,000 into 20, 6,000 into 60. I'll not include depreciation because I'm following a cash cost approach. Your COP, COGS, GWC, all that will be 6,000 into 160 into 160. Now WIP estimation, what I'm going to do is, my raw material is 4,80,000 into 100% into 0.5 by 12, and others are also 4,80,000 into 50% into 0.5 by 12. They have said 50% complete for conversion. Conversion is cost other than material. Conversion is cost other than material. When it comes to your estimation of debtor, cash sales are 75% less than credit sales. So they have mentioned cash sales is 75% less than credit sales. It does not mean cash sales is 25, credits is 75. Nothing like that has been mentioned. Cash sales is 75% lesser than credit sale. Cash plus credit is equal to total sales. Cash is 0.25 credit sales. 0.25 credit plus credit is equal to total sales. In short, 1.25 credit sales is equal to total sales, and my credit sales is total sales divided by 1.25. Technically it will be 80%. Credit sales is 80%, cash sales is 20%. Credit sales is 80%, cash sales is 20%, and you will have to do that on 9,60,000. You will have to do that on 9,60,000. That's okay. Any of the approach you follow, total approach or cash cost, that's up to you. Okay, go through 10. Go through 10. This is a newly formed company. Go through question 10. Go through question 10. This is for a new company. I'll take you through a detailed cost sheet. Friends, please go through the problem. I don't want any discussion. Go through the question. It's a newly formed company which has applied to a private bank for the first time for financing its working capital requirements. Estimated level of activity 31,200, WIP 12,000, raw material, wages, overheads which includes depreciation, selling price, raw material in stock, WIP 100%, 50%, FG stock is 24,000, supplier, debt, purchaser, direct wages, lag, expected cash balance, assume that production is carried on evenly throughout the year, wages and overheads accrue similarly. All sales are on credit basis. You are required to calculate the working capital requirement on cash cost basis. We are required to do it on cash cost basis. Let's first prepare a cost sheet. The cost sheet will be a detailed cost sheet. Particulars, calculation amount. Moment you are done with the cost sheet, you will also get the answer of three things, which is your closing raw material, closing WIP and closing FG in the cost sheet itself. That will go to the estimation. So the cost sheet is very critical here. Particulars, calculation amount. Direct material, underline that. Opening raw material, add purchases, less closing raw material consumed. Opening is 0. This is where the difference comes. Opening raw material is 0, add purchases, less closing raw material consumed. Now listen, my cost is 40 per unit. I have produced 31,200. WIP is 12,000. I also incur raw material cost for WIP. So I'll incur it on 43,200 units, provided the degree of completion for WIP is 100%, which is given in the question. The degree of completion for material is 100%. So my raw material cost is 40 into 43,200. 40 into 43,200. 40 into 43,200. Sorry. This is here, okay. raw material consumed. Raw material consumed is 40 into 43, 200, which is your 17,28,000. Closing raw material is, they have said average 30 days consumption. Average 30 days consumption. So this is 1728 into 30 by 360. 30 by 360. And purchases, which is a balancing figure. Purchases, which is a balancing figure, is reverse working 18,72,000. When you calculate creditors, you will have to calculate on 1872. When you calculate raw material, you will have to calculate on 1728. Anyway, that's already done. I'm just going to copy paste this in my estimation later. Clear? Any doubts on this? No, I have not done the purchase creditor calculation. Where have I done the creditor? I said when you do the creditor calculation, you will have to do it on 18,72,000. This is stock of raw material. Where is creditor here?
No, sir, I thought it's 60 by 360.
So what is the stock of raw material?
Sir, raw and consumed 17,28,000, sir.
What is the stock of raw material?
Sir, that's what I thought it was 60 days, sir. If you
No.
multiply only, you'll get the closing stock. Like the
That is creditor, no? Credit allowed by purchases, creditor.
I got confused.
Okay, not an issue. Next is direct wages. Direct wages will also be on 43,200 provided the degree of completion is 100%. Whereas what they mentioned, degree of completion is 50, which means it will be on 31,200 and half of 12,000, which is 6,000. Half of 12,000, which is 6,000, which is 37,200. So this will be 15 into 37,200. 15 into 37,200. Because the question said 50% degree of completion for your conversion cost. Then overheads other than depreciation, anyway I am not going to write depreciation, overheads other than depreciation is 30 into 37,200. I could have written depreciation if it was a total approach, that would have been 10 into 37,200 into 37,200. This stage we get GWC. This stage we get GWC. In this, opening WIP is 0 less closing WIP. Opening WIP is 0 less closing WIP. Closing WIP is simple. Whatever you had added earlier, you did not do it on 31,200. You did something on 43,200. So raw material will be your closing WIP 40 into 12,000. This is raw material addition. 40 into 12,000. Then 15 into 6,000 and 30 into 6,000. 40 into 12,000, 15 into 6,000 and 30 into 6,000. This I need to subtract now. This needs to be subtracted, and listen. You will get NWC COP. How many units have been produced by the company? How many units are produced by the company? Something is mentioned in the question.
24 finished goods.
31,200. And if you divide this by 31,200, you will get the cost per unit, which is 85 rupees. You will get the cost per unit, which is 85. What we did indirectly is we added 12,000 in material cost, we added 6,000 in raw material direct wages, we added 6,000 in overheads, and then removed that as part of closing WIP. Remove that as part of closing WIP. If you don't add it, you will estimate this wrongly. This estimation can go wrong. So you added it and now you have removed it. Added and removal is also done. So you get to the COP number. Add opening FG less closing FG. I don't have any opening FG. Closing FG, how many units are given in the question? 24,000 into 85. 24,000 into 85. Sorry? 40 plus 15 plus 30 rupees. 40 rupees of raw material, 15 rupees of wages, 30 rupees of overhead. We are following cash cost approach. So 40 plus 15 plus 30 rupees. That's how you get the 85. So closing FG, COGS. I think COGS or COS. We don't have anything else. COGS or COS. Have they given the selling price in the question? Okay. Anyway, cash cost approach selling. Okay. Anyway, doesn't matter. It doesn't matter. I am following cash cost approach. I am following cash cost approach. Now once this is done, stock of raw material is calculated, stock of WIP is calculated, stock of FG is calculated. These three things you copy paste. These three things you will copy paste in your cost sheet. Apart from that, I'll read if at all anything else is there. Nothing is there, nothing is there. Finished goods is done. Credit allowed by supplier is 30 days. So your supplier is this 18,72,000 into 30 by 360 on purchases, on purchases. Credit allowed to purchaser is your customer. This is credit allowed to purchaser on cash cost of sales, which is on 6,12,000 into 60 by 360. 6,12,000 into 60 by 360. Wages 15 days, you have your wages figure. 5,58,000 into 15 by 360. Cash balance is given. So almost everything will get estimated here. Almost everything will get estimated. And see here, stock of raw material, stock of WIP, stock of FG was copy pasted from this. Balance you do the estimation. Balance estimation you can do, which is a fairly simple thing. Question 11, try to prepare a cost sheet. Try to prepare a cost sheet. Same logic which I said. Try to prepare a cost sheet. Do it under total approach. Prepare a cost sheet under total approach. Prepare a cost sheet. In the cost sheet, most of the times will get estimated. Most of the items would get estimated. If you get the cost sheet correct, the problem is almost over. Beyond that, I'll talk on MPBF. The question also wants us to calculate MPBF. I just want the cost sheet. I'm not bothered about estimation. In the cost sheet, anyway, 3 items will get estimated. Stock of raw material, stock of WIP and stock of FG. So please do that quickly. Do the cost sheet quickly. We'll do total approach. Almost the same format it will be. Even a similar question only, but I want you to do this properly. What will be the raw material consumed figure? What into what?
8640.
No, what into what, you just tell me. How many units into what you are multiplying?
Sir, 1,08,000
1,08,000 into 80. 1,08,000 into 80. What is 1,08,000 is production of 1,04,000 and WIP of 4,000, which is fully complete. WIP is fully complete. 86,40,000. Closing raw material is 4 weeks consumption. 4 by 52. 4 by 52. Purchases will become a balancing figure. 93,04,615. Purchases will become a balancing figure. 93,4,615. Purchases is a balancing figure. Wages what into what? 1,06,000 because only 50% complete. So 1,04,000 is complete. 2,000 of incomplete. 2,000 incomplete. 1,06,000 into 30. Overheads other than depreciation is 1,06,000 into 60. Depreciation is not there. GWC. Opening WIP is not there. Now 4,000 into 80 remove material content and 2,000 into 90 wages and overheads put together. I have added them. 4,000 into 80 and 2,000 into 90. I am removing this. The reason for adding and removing it, if you don't add it, you will estimate your stock of raw material will be lesser, your purchases could be lesser. So all that can go wrong. This will technically be 1,04,000 units into 170. It will technically be 1,04,000 into 170. How much is the closing FG? Closing FG is how many units? 8,000 into 170. 8,000 into 170. 1,63,20,000. Your selling price given in the question is 200. So 96,000 into 200. Balancing figure profit is this much. Any doubts on this? Any doubts on this part? Now, when I do this, I've already got 3 items which I wanted. One is stock of raw material, stock of WIP, stock of FG. I'm not getting into the balance estimation, but I want to do MPBF. I want to do MPBF, maximum permissible bank finance. Any doubts till this? Once you are done with this, the question, if you had solved it fully, your current asset in the question is 55,03,461. This would have been the current asset figure. Okay. Current liability is 8,07,471. And question somewhere said maximum permissible bank finance under 3 methods if core current asset is 20% of total current asset. I want something called as non-core current asset. Can you tell me 80% of this is how much? Non-core current asset. Core is 20%, non-core 80% of 55 lakh.
44 lakh 2,768.
Okay. So assume you have got all these 3. You have done your calculation. Now MPBF works through 3 methods. See, the MPBF was introduced by, see, the purpose of doing working capital estimation is you will go to the bank, present this statement and ask for a loan from the bank because you need money to run your day-to-day operations. So bankers will not give you entire money because if they give you entire money, then the promoter has not put any money from his side. So we want promoters also to put money. So there is a method 1 in which what we do is 75% of current assets minus 75% of current liabilities. I'll not do the calculation, I'll just write it. 75 into 55,3,461 minus 75% into 807,471. This is one method. This is one method. Method 2, what the banker is going to do is 75% of current assets minus 100% of current. In this method, you will get lesser loan. In this method, you are going to get even a lesser loan because there you were subtracting only 75% of current liability. Now you are saying you are going to subtract 100% of current liability. Method 3, 75% of non-core current asset, 100% of current liability. So you will do 75% of 44,02,768. 44,02,768 minus 8,07,471. The last method will give you the lowest answer. So different methods you will have funding requirement. So first method you will give 35,21,993. Second method 33,20. Third method, theoretically we take the lowest of the 3, but in a practical world different industries different methods use. So these are the answers under 3 methods of your This is called as MPBF, maximum permissible bank finance. I also want to discuss one more item, and after that we'll take a break. Now we calculate this reserve for contingency 12%. For example, this is the question where the working capital was 6,51,250, reserve is 78,150, final answer is 729,400. Some question will say the company plans to maintain a contingency of 12% on the final working capital including the contingency, on the final working capital including the contingency. In that case, what you need to do is, you have calculated 651,250 contingency and final is taken as 100, contingency is taken as 12, and the working capital which you have calculated is 88. Normally you take 12% of 651,250. In this scenario, what you need to do is 651,250 into 12 by 88 into 12 by 88, because the working capital contingency is on this number. The 740057 you don't know, on this it is 12%, which is 88,807, but you don't know that number. So that is why what you do is, you first calculate 651,250, after that you say that is 88, contingency is 12, final answer is 100. So my contingency figure is the earlier figure which you have calculated into 12 by 88 into 12 by 88. Clear? Any doubts on this? Okay, let's take a break of 45 minutes and then we resume again.